I'm Barry.
And I'm Steve. Barry, what's our latest topic of interest? I'm excited.
Today we are going to be talking about income from a high cash value whole life policy. How do you generate tax-free income?
Cool. So people doing some retirement planning possibly, or just wanting that income stream. This is going to kind of talk about that.
Exactly. So we're going to look at a high cash value whole life insurance policy that's overfunded with maximum cash value. And not only does it allow a person to be their own bank along the way, this is a tax-free stream of retirement income. So Steve, it's really a retirement plan similar to a 401k or an IRA, except no market volatility, no penalties if they access cash before 59 and a half. And rather than tax deferred, we can show people how they can make the income tax-free.
Right. We've talked about the retirement tax bill. That's been a term that's thrown out there right now. People are looking for alternatives, right?
Yeah, they want alternatives. If taxes go up, we're going to all want as much tax-free money as we can get in the future. So let's look at this. High cash value whole life. We're showing on this particular illustration a 40-year-old male and $30,000 a year of premium going into the policy. Now, for you listening, you may want to do more than this. You may want to do less than that. But 30,000 a year is what we're using for the example. And you'll notice that the cash value here is growing every single year. This cash value is liquid. This person could use the cash value anytime they want. They don't have to wait till they're 59 and a half. What we want to focus on is what happens after the age of 65. Because there's no more premium going in at this point. So we'll come down here. We see at age 66, the outlay is done. $750,000 is what has gone into the policy. So that was $30,000 a year over 25 years. And this person is no longer going to put any more money into the policy. At age 68, this is when they're going to start taking income right there. $110,000 a year. And what I'm showing is close to the maximum amount that they could pull out. This is a consistent $110,000 a year. If one year they want to do 120 and the next year they want to do 50, they sure can do that. But we want to see a consistent amount. And Steve, check this out. 110,000 from the age of 68 to the age of 88. That's 21 years of income.
So Barry, just to kind of stop you for a second, you got 110,000. That's a lot different than if you were taking 110,000 out of say an IRA or a 401k, correct?
Yeah, depending on someone's tax bracket. If this money were in a 401k or an IRA, they might have to pull out 140, 150, 160,000, pay the tax to net down to the 110. As long as someone doesn't mech the policy, that's in another webinar they could watch, as long as they fund a premium at least 7 years, and as long as they keep the policy in force until they pass away, we can show them and teach them how all this 110,000 of income can truly be tax-free. And what they're going to do is they're first going to take out the 750 as a withdrawal. They put in 750, they're going to take out the 750 as a withdrawal. After they've exhausted the 750, then they start taking policy loans. And what's true about policy loans, Steve?
They're not taxable.
Correct. They do not have to be reported on your tax statement. You can truly have that money come to you tax-free. And in retirement, you don't pay the money back. That will simply come off of your death benefit over here once you pass away. But here is the huge culmination of what's happened. If we take the 750,000 that someone's put in and look at what do they get as far as income coming out, 110,000 every year for 21 years. Steve, they can pull out 2.3 million tax-free. They only put in 750,000.
Yeah, that is massive leverage.
That's a huge amount of money for someone to be able to take out completely tax-free. Imagine having this in your portfolio. Most people out there have tax-deferred money for retirement. When they take the money out of the 401k or the IRA, it's 100% taxable. Who knows what future tax rates will be 10 years, 20 years, 30 years from now? So the more tax-free money you have in retirement, the better retirement you're going to have.
Right. And Barry, you're taking money out as policy loans. And so that cash is really still working within the policy itself, right?
That's correct.
That's another aspect. So it seems like you have multiple levels of benefit going on here.
True. And that's why someone was able to turn 750,000 into 2.3 million, because money was still working for them in the policy, even though they had loans. So to learn more, click the link below. You can schedule a call with us. We have many, many more webinars that Steve and I have done at Insurance and Estates. We look forward to talking with you. Click the link below, and we hope to talk with you soon.